Good afternoon. Welcome. You're watching BQ Prime. I'm Hersh Sayta. Over the next 10 to 15 minutes, we will be interacting with the management of Galaxy Surfactants. We have with us Mr. Shekhar, who's the managing director there, of course, the promoter as well. Pleasure having you here as well as interacting with you, Mr. Shekhar, to try and break down these numbers for the benefit of our viewers. So let me first start off with volume growth. It's come in better than even the top end of your guidance of 6 to 8%, right? The volume growth of roughly 8.5% this time around, if I'm not wrong. So where should we see that in the second half of the year? How should one look at traction in volumes? And therefore, would you be looking to beat your guidance of 8% plus?
Yeah, if the tempo is maintained the way quarter one and quarter two has been, which has been on a what is called upward trend, we should be able to beat our indications of volume growth at the higher end. That is what we are aspiring for. That is what we would like to see in the coming 2 quarters, and end the year on an overall basis much higher than the volume trend that we have indicated. Yeah.
Right. And what's the likelihood of that? You're expecting a better second half, definitely, which means that it will be a beat. But you seem to suggest that there are certain factors also at play. So what are those factors? What's the likelihood of that playing out?
See, the key factors which can play for it, of course, is the continuing India rocking story, one. Demand coming back on AMET region, that is Africa, Middle East, Turkey region. Asia Pacific continuing to perform well. And the US market, which has been really down over the last few quarters, coming back in terms of consumption. We are a little pessimistic there as far as US is concerned. We feel that US will start correcting maybe in the first quarter of the next financial year. We expect US to be depressed, maybe even this quarter as well as the coming quarter. But even with all those things, we do feel optimistic as far as the next 2 quarters are concerned. So hopefully we should be able to surpass the upper band in terms of the volume growth.
Right. And, when I'm looking at it sequentially, margins have taken a bit of a knock. How do you see a margin evolution? Because with strong volumes, can we see margins, rather expected to hold up? How should one look at it?
So we have already said, for the entire year, one can expect the EBITDA per ton to be between 19,500 to 20,500. And the EBITDA per ton will start going up once the specialty chemicals come back strongly in terms of consumption, which I think we should wait for maybe another 1 or 2 quarters before they start kicking in terms of consumption growth. And as I said, the developed markets are where the specialties are consumed significantly. So they have to look up.
Right. And could you therefore tell us between surfactants as well as specialty, what would the margin differential be like? How should one look at margins in both those products typically, just for the benefit of viewers?
No, we wouldn't like to dwell specifically on the margins between two. Suffice it to say that the specialties certainly enjoy more contributions and margins compared to the performance surfactants. Performance surfactants, as you know, are bulk products in terms of volumes, whereas specialties are niche products which are, in terms of volumes, they are lesser in terms of quantum compared to the performance surfactants. Of course, the number of specialty ingredients number quite a bit. There are many SKUs and number of products in various categories as far as specialty products are concerned, including, say, transparent bathing bars, Simdets, mild surfactants, preservatives, preservative blends, proteins, and so on.
Right. And
Whereas performance surfactants, as we have, yeah.
sorry, please go ahead.
Whereas performance surfactants, as we have defined it, are based on fatty alcohol as the basic raw material. Yeah.
So one should start to see on the specialty side, one should start to see some amount of restocking happening Q1 FY25, and therefore EBITDA per ton go more towards that 20,000, which is currently at around 19,500, start to go creep up towards that 20,000 and 20,500 only after that. Is that the right way to look at it?
Right.
Awesome. Perfect. Got it. Okay. And to try and understand, is there a China impact on both on your margins overall? Could you talk to us about a risk or an impact coming there, as well as any other risks to margin profile going forward?
See, China has never been a very significant factor, though they do, play on and off, more particularly in the Africa, Middle East, Turkey markets. Yeah, otherwise, in all other regions, China has not been any significant player over the last many years. So these are all driven by individual, regional developments. Whether it is Europe again, which has been racked by a significant amount of, fuel inflation, and cleaning up the pipeline in terms of stocks. The same is the story as far as US is concerned. So more and more, consumers, because of the inflation in these countries, are tilting towards the masstige products and masstige brands, and less in terms of prestige products, because they are balancing their wallets. And you have a limited valet, and inflation, makes you adjust your valet in terms of the portfolio of products that you consume.
Right. And you've also opened a new office in Europe. So how should that add to the current existing business with regard to both surfactants as well as specialty? How should what's the plan there with regard to Europe? My guess is it'll be adding more to the specialty side of things.
Yeah. See, we have been present in Europe for now almost more than 15 years. What this office, the purpose of this office is to enable us to have warehousing space in Europe, so that we are able to be more nearer to our customers in terms of responding to their inquiries, orders, and then delivering it, just in time. That's the objective of this office. Otherwise, Europe has been an important market for us over the last 10 to 15 years. We have built relationship with customers across various countries in Europe. This will only enable us to be more nearer to customers and respond to them more promptly, more speedier way.
Right. And with regard to both wallet share as well as market share of existing customers as well as market share overall, what are the trends you're seeing, or is what's the kind of foothold that Galaxy has currently, and where is it looking to further strengthen its foothold going forward?
Yeah, see, we have a very, very long-term relationship with all the customers with whom we have we have been dealing with. So the relationship will go anywhere from, let us say, 10 years to even 35 years, 40 years. Now, that is the type of relationship that we have with customers, one. Number two, as customers expand their product portfolio, it gives us an opportunity to have a wider share of their wallet, both in terms of portfolio of products and the size of wallet. That is what we have been doing. And this comes because once a trust and a long-term working has been established, customers, expand their, purchasing wallet to more and more products of ours. So this is something that will continue. And we again come up with various innovations year on year in terms of expanding our product portfolio. And all these, go towards taking a share of the value of the customers. So as far as specialties are concerned, they have been the main, they have been largely used by European as well as US customers. India, is slowly, building itself in terms of specialties consumption, whereas Africa, Middle East, Turkey market will be largely a performance surfactants-driven geography. So that tells you the spread of performance and specialties in various geographies and various markets.
Understood. And, a couple of quick questions to close this. One is on your R&D pipeline spend along with CapEx as well. How should one see that add to your top line over the next couple of years? If you can talk to us about that, as well as, of course, the existing facilities adding to your top line as well, along with pricing. So how should your top line evolve, say, by FY26, if I were to look at it? What's the kind of growth that you would want to clock? If you can talk to us about that.
See, we would like to maintain the volume growth that we have indicated in various markets, growing ahead of the market. Particularly, India has done pretty well. What has been happening in India is more and more penetration of the personal care products as well as home care products. Particularly the liquid detergents have been doing pretty well in this country, clocking almost double-digit growth, year on year for our customers. Driven, of course, by convenience and more penetration of washing machines in the country. So similarly, household care has again, been on the upswing with respect to consumers. And COVID did give a good trigger as far as hygiene and household care is concerned. So India we expect to be continuing to be a very growing and robust market in the coming years, and we should also expect similar with respect to Africa and Middle East, though they have been rocked by runaway inflation. Egypt has been rocked by runaway inflation. Even at something like 60 and 70% level, we expect these to moderate, which should make customers expand their portfolio of usage of the various products. US again has been reeling under inflation, and we should expect all these to moderate. That is what our aspiration or our outlook, or that is what we would hope in the various
Right. So you clocked roughly 4,500 crore of top line last year. Can one expect a flattish top line this year? And where should that go? Maybe next year, maybe a 10%. You're guiding for an 8% volume growth. So how should it be? Early single digit kind of growth or early teens growth on the top line?
See, as far as top line is dependent upon the value of or the input cost of the raw materials. As you know, the prices of our raw material, that is laurel alcohol, etc., have corrected quite a bit. So we measure ourselves only by volume growth, and the value growth or the top line growth is a derivative of volume growth. If the prices of raw materials go upwards, the top line also goes in sync in terms of those volume growth. Provided, as I said, if the prices go on the upside, whereas now prices of raw materials have remained more or less very benign over the last almost now a year or so. There is volatility, but they have remained within a particular band of value.
Right. And with the new product pipeline that is expected to come through, you have a large one. Should we therefore continue to see margins around the 13% to 14% kind of range? Would that be reasonable?
So as I said, again, margin is a derivative of the top line and contribution per ton. See, what is important for you to note is that we measure ourselves by volume growth. So if, let us say, the prices of raw materials come, and again the prices of the finished products are in sync with the raw material prices, at a low raw material price, you would see the EBITDA per ton margin or I mean the percentage higher. And the reverse will be the case if the raw material prices zoom, and again the finished product prices go in sync with those raw material prices. So this band can be anywhere between, let us say, 12 to maybe 15% or so.
Understood. Got it. It's been a pleasure speaking with you, sir. Thank you so much for all the perspective that you've given us.
Pleasure, Harsh.
Right.
Thank you. Thank you.
Right, sir. So it's been a pleasure speaking, and thank you for that. Of course, more focus on volumes rather than on the top line as well as EBITDA is essentially what Mr. Shekhar has told us about Galaxy Surfactants. Of course, decent set of numbers. The stock itself down around 0.5% or thereabouts in trade today.